Preparing for EDP FP&A Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A mean to you, and how would you add value at EDP? FP&A is the process of translating strategy into budgets, forecasts, performance analysis, and decisions. At EDP, I would connect operational drivers, generation volumes, capacity factors, power prices, network costs, and financing, to financial outcomes. I would compare actual results with plan, explain variances, refresh the outlook, and highlight actions. The objective is not merely reporting numbers, it is helping leaders allocate capital and manage volatility with confidence. While answering, focus on translating strategy into forecasts, connecting operational drivers to financial outcomes, explaining variances, supporting capital allocation, and communicating recommendations clearly to business and finance stakeholders. Question 2. What is the difference between a budget and a forecast? A budget is a fixed annual plan built from strategic assumptions. It sets targets for revenue, costs, CapEx, cash flow, and headcount. A forecast is a living estimate updated as actual data, market conditions, and operational expectations change. At EDP, I would use the budget as a baseline, not a constraint, then explain deviations and reforecast expected full-year results. This distinction supports accountability and better decisions. Make sure to cover the budget's role as an approved baseline, the forecast's role as an updated expectation, changing assumptions, accountability, and how both tools support planning and decision-making. Question 3. How would you build a rolling forecast for an energy business? I would begin with a rolling 12 to 18-month horizon and build the model around operational drivers rather than arbitrary growth rates. For EDP, those drivers could include installed capacity, production volumes, weather, power prices, tariffs, operating costs, and project timing. I would load actuals, update assumptions with commercial and operational teams, run sensitivities, and document changes. Each cycle should explain what changed, why it changed, and the financial consequence. In your answer, talk about the forecast horizon, driver-based modeling, historical actuals, market assumptions, operational inputs, scenario analysis, stakeholder reviews, and disciplined monthly or quarterly updates. Question 4. How do you perform a meaningful budget versus actual variance analysis? I start by identifying material variances, then decompose them into volume, price, mix, timing, foreign exchange, and cost rate effects. For example, lower renewable output may reflect weather, while higher maintenance expense could be timing-related or structural. I validate the explanation with the responsible business owner, distinguish one-off from recurring impacts, and quantify the forecast implication. My report would emphasize root cause, corrective action, owner, and expected resolution date. Be sure to mention materiality, price-volume mix analysis, timing versus permanent variances, controllable versus external drivers, root causes, action ownership, and concise management reporting. Question 5. How do the three financial statements connect in an FP&A model? The income statement shows profitability, the balance sheet shows resources and obligations, and the cash flow statement explains cash movement. Net income flows into retained earnings. Depreciation reduces profit but is added back in operating cash flow. CapEx increases assets and reduces cash. Debt affects both liabilities and financing cash flow. In FP&A, linking all three prevents inconsistent assumptions and makes liquidity, leverage, and return analysis more credible. Focus on net income, working capital, depreciation, CapEx, debt, cash flow, retained earnings, balance sheet checks, and why statement integration improves forecast reliability and decision usefulness. Question 6. How would you forecast revenue for EDP? I would forecast revenue by business segment and use the underlying economics of each activity. For generation, I would model installed capacity, expected production, capture prices, contracted volumes, and merchant exposure. For networks or customer activities, I would consider connections, demand, tariffs, churn, and regulated assumptions. I would layer in foreign exchange and weather scenarios, reconcile the result to historical trends, and clearly separate volume, price, and portfolio effects. Discuss segment-specific drivers, production and capacity, contracted versus merchant exposure, tariffs, customer volumes, pricing, foreign exchange, weather, and reconciliation to historical performance. Question 7. How would you explain an EBITDA variance to senior management? I would present a bridge from budget EBITDA to actual EBITDA, separating revenue effects, operating cost movements, foreign exchange, timing, and exceptional items. For instance, weaker wind could reduce production and revenue, while a maintenance outage might increase costs. I would quantify each driver, confirm the operational narrative, identify whether the impact is recurring, and update the forecast. Senior management should finish with a clear view of performance, risk, and required action. Mention an EBITDA bridge, revenue and cost drivers, controllability, recurring versus non-recurring items, operational context, forecast impact, and an action-oriented executive summary. Question 8. How would you analyze working capital in an FP&A role? I would analyze working capital through receivables, payables, inventory, and business-specific balances such as energy settlements or accrued costs. I would track days metrics, aging, seasonality, payment terms, and movements against budget. Then I would separate operational changes from accounting timing and identify actions, such as improving collections or aligning supplier payments. The result should connect working capital movements to cash flow, liquidity headroom, and the forecast balance sheet. Cover receivables, payables, inventory, operating cycles, cash conversion, seasonality, overdue balances, supplier terms, business-specific factors, and practical cash improvement actions. Question 9. How would you evaluate and monitor capital expenditure at EDP? I would begin with the approved project pipeline and reconcile each project's budget, committed spend, actual spend, forecast to complete, and expected completion date. For EDP, renewable and network investments require close attention to construction progress, permitting, procurement, inflation, and financing. I would monitor return metrics such as project IRR, payback, and value creation against the business case. If assumptions deteriorate, I would escalate early and recommend reprioritization or corrective action. Focus on project pipeline, approved business cases, spend timing, committed versus incurred costs, benefits, return metrics, risks, stage gates, and post-investment review. Question 10. How would you build a scenario analysis for changes in power prices? I would first map EDP's exposure by market, technology, contract structure, and forecast period. Then I would define base, upside, and downside power price curves, keeping production, hedging, and contracted volumes explicit. The model would show effects on revenue, EBITDA, cash flow, leverage, and investment capacity. I would also test combinations with lower output or higher interest rates. Finally, I would explain the decision implications rather than presenting scenarios without recommendations. Mention base, upside, and downside cases, exposure mapping, production and contract assumptions, EBITDA, cash flow, and leverage impacts, sensitivities, and management implications. Question 11. Which Excel techniques are most important for an FP&A analyst? I rely on a clear model structure separating inputs, calculations, outputs, and checks. Useful tools include SumIfs, XLOOKUP, index match, pivot tables, dynamic ranges, scenario switches, and conditional formatting. I avoid unnecessary hardcoding, label assumptions, and build checks for balance, completeness, and unusual movements. Before sharing a file, I test key formulas and trace outputs back to source data. Excel should make analysis faster while remaining transparent and auditable. Be sure to mention structured models, SumIfs, XLOOKUP or index match, pivot tables, error checks, scenario switches, data validation, documentation, and avoiding fragile hard-coded formulas. Question 12. How would you use Power BI or other reporting tools in FP&A? I would use Power BI to automate recurring reporting and give stakeholders a consistent view of actuals, budget, forecast, and key operational KPIs. I would first confirm source definitions, ownership, refresh frequency, and reconciliation to the general ledger. Dashboards should show headline performance, then allow drill down by segment, geography, or driver. I would keep visuals focused and use commentary to explain movements, because automation without reliable definitions only accelerates confusion. Discuss data quality, source integration, automated refreshes, dashboard design, KPI hierarchy, drill down capability, user needs, reconciliation to official numbers, and avoiding visual overload. Question 13. Which KPIs would you monitor for an energy company like EDP? I would combine financial KPIs with operational indicators. Financial measures include revenue, EBITDA, operating cash flow, CapEx, free cash flow, net debt, and leverage. For generation, I would monitor installed capacity, production, capacity factor, availability, realized prices, and capture rates. For networks or customer activities, I would consider regulated returns, connections, demand, churn, and service quality. The right dashboard links each KPI to value creation, risk, and management accountability. Include financial and operational measures such as EBITDA, cash flow, CapEx, leverage, production, capacity factor, availability, prices, customer metrics, and segment-specific performance indicators. Question 14. How would you manage the monthly forecasting and reporting cycle? I would work from a documented calendar with clear owners and deadlines for actuals, submissions, review meetings, forecast updates, and reporting. After loading data, I would reconcile totals, investigate unusual movements, and validate assumptions with business partners. I would maintain version control and retain an audit trail for material changes. Before publication, I would perform reasonableness checks and ensure commentary explains both performance and outlook. Early escalation protects the timetable. Cover close calendar discipline, data collection, reconciliations, variance review, stakeholder deadlines, version control, quality checks, commentary, and escalating unresolved issues promptly. Question 15. How would inflation and interest rates affect your FP&A analysis at EDP? Inflation can raise construction, maintenance, labor, and procurement costs, while higher interest rates increase financing expense and may reduce project values through higher discount rates. I would identify which costs or revenues are indexed, fixed, contracted, or exposed, then model the timing of impacts. For EDP, I would test effects on CapEx affordability, EBITDA, cash flow, leverage, and project returns. I would also consider refinancing risk and mitigation through hedging, repricing, or reprioritization. Mention operating costs, construction budgets, financing expense, valuation, discount rates, debt refinancing, regulated returns, scenario sensitivities, and potential mitigating actions. Question 16. What is the difference between regulated and merchant energy businesses from an FP&A perspective? Regulated businesses generally earn returns within an approved framework, so forecasting emphasizes allowed revenues, asset bases, tariffs, service levels, and regulatory decisions. Merchant businesses depend more directly on market prices, production, hedging, and demand, creating greater earnings volatility. In FP&A, I would use different driver sets and sensitivities for each. Understanding that distinction prevents applying a stable regulated growth assumption to a business exposed to commodity cycles and weather. Explain revenue predictability, regulatory frameworks, market price exposure, allowed returns, operational risks, forecasting assumptions, and how different risk profiles influence capital allocation. Question 17. Tell me about a time you challenged a business stakeholder's forecast. In a prior project, a stakeholder assumed strong volume growth without supporting customer or capacity data. I first understood the commercial rationale, then compared the assumption with historical trends, pipeline evidence, and operational constraints. Rather than rejecting it, I proposed a base case and an upside case tied to specific milestones. We agreed to use the base case in the forecast and monitor leading indicators. That preserved credibility while keeping the upside visible. Use a structured example showing respectful challenge, evidence, driver validation, collaboration, revised assumptions, measurable outcome, and maintaining the relationship after disagreement. Question 18. Describe a time you found an error in a financial model or report. I once noticed that a reported margin movement did not align with the underlying volume trend. I traced the formulas and found that one period's cost data had been mapped to the wrong business unit. I corrected the mapping, reran the analysis, reconciled it to the source ledger, and informed the reviewer immediately. I then added a cross-check comparing source totals with report totals. The experience reinforced that curiosity and control discipline matter equally. Focus on how you detected the issue, isolated the root cause, assessed materiality, corrected and validated the output, communicated transparently, and improved controls to prevent recurrence. Question 19. If actual renewable production is below forecast, how would you investigate and update the outlook? I would separate the shortfall into weather, availability, outages, curtailment, commissioning delays, and forecasting error. I would compare actual production with resource conditions and asset-level operating data, then assess whether the issue is temporary or likely to persist. I would quantify impacts on generation revenue, EBITDA, cash flow, and contractual obligations, including any price offset. After validating assumptions with operations, I would update the forecast and clearly communicate downside risk and recovery actions. Mention variance decomposition, weather, availability, curtailment, outages, capacity additions, realized prices, contract exposure, persistence assessment, and revised revenue, EBITDA, and cash flow implications. Question 20. Why do you want to join EDP as an FP&A analyst? EDP appeals to me because it combines a complex, capital-intensive business with a meaningful role in the energy transition. FP&A would let me connect renewable generation, networks, customers, investment decisions, and market volatility to financial performance. I would bring strong analytical discipline, curiosity about operational drivers, and clear communication with non-finance teams. I am especially motivated by turning data into practical recommendations that improve forecast quality, capital allocation, and execution. Connect EDP's energy transition strategy and international scale with analytical motivation, operational learning, stakeholder partnership, financial discipline, and a specific contribution you would make in the role. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.